Good morning, everybody, and welcome to BDO's Financial Services Economic Update. It is wonderful, as always, to see so many of our clients on this webinar. My name is Lee Tracy, and I lead BDO's Financial Services Advisory Team. And on behalf of all of us at BDO, we hope you and your loved ones are keeping safe and well during this difficult time. A few housekeeping points to note. This webinar is recorded, and we will share the slides and recording after the webinar for you to download. We will have time for Q&A at the end of the presentation, so please do send your questions in via the Q&A chat. If you have any technical difficulties, please also let us know through the chat function. While the global economy is gradually recovering from 2 challenging quarters of lost lives and livelihoods, the recovery is likely to be long and uneven and uncertain. Economies everywhere face difficult paths back to pre-pandemic activity levels. Indeed, compared to forecasts in June, prospects have worsened significantly in a number of economies where infections are rising rapidly again, our own included. With no certainty on a vaccine, the re-emergence of various restrictions poses substantial risk to the economic recovery path that we have been beginning to see over the last few months. The path ahead will require skillful navigation of domestic policies and coordinated international approaches that manage the trade-offs between lifting near-term activity and addressing medium-term challenges. In this context, I'm really delighted to introduce you to 2 of BDO's economists, who are also esteemed members of our regulatory and valuations teams, respectively. Dr. Sagar Sahar is a PhD with over 15 years of economic modelling experience, both as an academic and as a practitioner. His core area of expertise revolves around the development and application of computable general equilibrium models and other related classes of applied general equilibrium models to economic policymaking at a macro and micro level, as well as macroeconomic forecasting. Sagar has substantial experience in the insurance and banking industries, applying his modelling expertise in the quantification of risk and capital under Basel III and Solvency II regulatory standards. Tom Robinson is an economist with an in-depth knowledge of macro and microeconomics, econometrics and finance, including financial modelling and forecasting, and the valuation of financial assets and derivatives. He has a particular interest in the calculation of firms' cost of capital for the purpose of business valuation and calculating the present value of cash flows. Together, Tom and Sagar, over the next 40 minutes or so, will take us through the global and the UK economic recoveries to date and what the economic forecasts are predicting for the next 12 to 15 months. On that note, I'd like to hand over to Sagar.
Hello, everyone. Good morning, and glad you could join us on this wet and miserable morning in London. I'm going to start off by having a quick look at the global economy. And I'm going to hand over to Tom after that to take you through the UK indicators as well. So let me start off by looking at the near-term outlook first. If you have a look at the graphs that have been presented in front of you, the graph on the left-hand side of the panel looks at the quarterly world GDP figures itself. Clearly, the global economy is gradually climbing out of the abysses of 2020, but it's still actually prone to a whole range of setbacks. Economic activity seems to have picked up in the months of May and June as the economies reopened and as the Q2 growth figures were relatively positive on balance, but not uniform. For example, countries that exited lockdown earlier performed a lot better. For example, China was boosted by a public investment as opposed to India, which was in the grips of the pandemic itself. If you look at the US and the Eurozones and the advanced economies in general, there are mixed indicators over there. UK, since it came out of lockdown a little later, didn't actually, the Q2 wasn't as great as say a US or a Japan, which came out a lot earlier. Discretionary consumer spending seems to be up, and that's reflected in the volume retail sales on the right-hand side of that of that particular graph. But all high frequency data at the moment in Q3 seems to be suggesting that July, August were really good, but September's seem to be lagging behind a little bit because primarily of low demand and confidence resulting from the virus resurfacing again with multiple waves. What are the risks of some of these forecasts? Obviously, there's a high degree of uncertainty associated with the pandemic evolution itself, and a deep downturn could end up supplying potential to different kind of varying degrees in the different economies, primarily based on sectoral, occupational, and geographical factors. For example, the extent of insolvencies each economy suffers, the number of discouraged workers, the resource mismatches, etc. There's the financial conditions could tighten because the historical the debt levels are really, really high. Escalating geopolitical tensions and social unrest is also a factor to be looked into in some of these forecasts. But all of this kind of leads to the prolonged decline in activity leading to scarring itself. So if you lose jobs that can't come back, then you need to look at ways and means of getting those jobs back in sectors that are viable. Next slide, please, Laura. In this particular slide, we're looking at looking at the medium term itself. So on that graph to your left-hand side, you're primarily looking at GDP losses between January 2020 projections and October 2020 projections. And the GDP losses in the near term between 2019, 2021 to 2019, 2025. And as you can see, following the rebound in 2021, the growth globally is likely to slow around the 3.5% in the medium term dynamic itself. If we look at, say, the top 10 largest advanced economies, potential GDP in the medium term is expected on average to remain about 3.5% below the pre-pandemic projections. Whereas if you look at the 10 largest emerging markets, the decline is even larger at about 5.5% on average itself. Now, what does this drop in economic activity point to? Well, it points to a severe setback in the projected pace of improvement in the average living standards across all country groups. And that's the bit that we are covering on the right-hand side of that particular chart itself. Economic outcomes like inequality, average life expectancies, health outcomes, which are all positive externalities of economic growth, they're all going to be adversely impacted if the projections in the medium term stay subdued. So what are the key features that are shaping this medium term outlook? Obviously the structural slowdown in China, but that actually preceded the pandemic and is expected to continue following the strong cyclical rebound in about 2021. The commodity prices are weighing down heavily on the global growth. There are weak prospects of probably external demand related to expected moderation in the advanced economies and the growth levels in the advanced economies. And primarily for tourism dependent economies, it is a pretty grim picture, and persistently low cross-border travel is impacting a lot of these tourism dependent economies itself. Next slide, please. So this, from the medium term, we look at some of the economic indicators globally. So inflation is obviously a major indicator itself of where we expect ourselves to be in the short to medium term. There's been a sluggish rebound in the commodity prices, but the inflation expectations remain very low. Inflation in advanced economies pretty much remains below the pre-pandemic levels, in line with the subdued economic activity. And we expect the inflation to remain below the target over the medium term. In emerging economies and in developing economies, the inflation declines sharply after the initial stages of the pandemic. So around March, April timeframe, it kind of plummeted. But it has since picked up in some of the countries. India, for example, has had inflation going back again, and that is primarily reflecting the supply disruptions and the rise in food prices itself. Inflation in advanced economies, around 0.8% in 2020, maybe rising to 1.6% in 2021 as the recovery picks up momentum, and then probably broadly stabilizing at around 1.9%, but under the 2.5% that most of the advanced central banks actually target. For emerging markets and for developing economies, inflation is projected at about 5% in 2020, but declining to around 4.7, 4.8% in 2021 over the medium term itself. But that is also, I mean, if you look at that group of countries, the 4.7% is historically a very low average for that particular group itself. But the interesting thing within this inflationary expectations slide is if you try and break it down into a sectoral decomposition of the inflation in the period leading up to the pandemic and in the 6 months after the pandemic set foot, it shows that across a cross-section of economies, the decline in inflation is relatively broad-based. So inflation has declined both in the cyclical sectors, which are, you know, the furnishing, the housing, you know, sectors which are where the price developments are sensitive to aggregate demand, or sectors that we call the luxury sectors. Whereas non-cyclical sectors or the necessity sectors, where price movements typically are less sensitive to demand fluctuations, have also similarly seen lower inflation across the board itself. So that's very interesting because typically in most of the recessions, it's not typically both the sectors going down in inflation itself. So with aggregate demand expecting to be relatively weak and economies projecting to be operating with a considerable slack well into 2022, price pressures in both sectors are expected to be muted. Next slide, please, Laura. Unemployment, it continues to rise. And it's not only unemployment, it's underemployment as well. And unfortunately, in this particular pandemic crisis, this is going to have a continued and disproportionate detrimental impact on the labor market worldwide, compared to some of the previous crises like the credit crisis of the 2008. This impacts the low skill, lower income group a lot more, the informal sector a lot more than it does the higher end of the labor population itself. So the pandemic's impacted, significantly on sectors that are more labor intensive. Substantial loss in working hours that you can actually see on that chart, about 10.5% worldwide in the second quarter. And if you equate that to actual volumes, the decline in Q2 2020 was equal to more than 400 million full-time jobs. By Q3, that's well into the 450, 500 million figure itself. So there's been a huge and substantial loss in working hours within the labor market. Now, what these trends actually translate into, which is not showing on the graph, is the losses in labor income as a result of that, because there's a demand component associated with it. The actual losses in labor income estimated globally is around 10.7%, or approximately $3.5 trillion during the first 3 quarters of 2020 compared to, say, 2019 at the same period. And that itself, if to put some perspective to it, is around 5.5% of global GDP. But these are people losing jobs. So poverty levels are increasing. Income support measures for vulnerable and hard-hit groups should actually be a policy priority, where governments are introducing forced restrictions to economic activity to contain the virus itself. It's absolutely essential that if this continues, and if there is no public support from the government, then there'll be swathes of unemployment, and entire sectors are going to go missing once we emerge out of the pandemic. If we look at the sectoral insights, which kind of give you a closer insight into what I was talking about in terms of the unevenness of this particular pandemic itself, the service sectors have been disproportionately affected and impacted by this particular pandemic. So any service sector that rely on face-to-face interaction, especially wholesale, retail, hospitality sectors have been hugely impacted. If you look at the purchasing managers index on the left-hand side of the graph, it shows that the United States, the Euro area, China, and Brazil, for example, they expanded output month on month in both July and August. But in India, Japan, and Korea, the recovery actually subdued. So there's no, the recovery is not even. There are countries that are still not recovering from the lows of the March, April, May lows itself. The September figures, they point to stronger activity in the manufacturing sector. But there's some setback in the services from the high frequency data that we're receiving, and that's primarily coming out probably because of the increase in infections in a whole range in a whole number of economies, especially in Europe. Also, the other high frequency data that at the moment is showing a bit of leveling off in the US consumer spending. So initially, when the economies emerged from the lockdown, there was a huge pent-up demand for consumer spending that came out in the months of June, July, August, but that's kind of leveling off a little bit at the moment. Next slide, please. So we talk about all of this support for unemployment, and that comes at a cost. Fiscal policy, there's been unprecedented levels of government support that has been that has been provided to different economies to mitigate the impact of the pandemic itself. The subdued medium-term growth prospect, it comes with a significant projected increase in the volume of sovereign debt, which was high to begin with. But these downward revisions in potential output also imply a smaller tax base over the medium term, which is going to be an issue when it comes to servicing the debt obligations itself. Sovereign debt, for example, just to give you some eye-watering numbers over here, it's projected to rise by about 20 percentage points to about 125% of GDP by the end of 2021. Over the same period, the sovereign debt in the emerging markets and the developing economies is projected to rise by more than 10 percentage points itself. Now, because of low interest rates, you could say that that it's probably easier to contain the debt service factor itself, but that is only a mitigation factor in the most advanced economies that are operating at negative yield on their sovereign bonds. The ratio of sovereign debt servicing expenses to tax revenue is increasing, and it's increasing largely within the emerging economies and the developing economies itself. So there is an inherent risk over there that one needs to look out for in terms of debt and fiscal policy itself. If we could move over to the next slide, please. Monetary policy has taken a slightly backstage in this particular pandemic because a lot of it has been dictated by fiscal policy. But if you look at but there has been significant monetary policy interventions. The sovereign bond deals, as you can see in the 10-year government bond deals, it declined even further in June. And the European, ever since the European pandemic recovery package was established, the corporate spreads have dropped further, particularly for the high yield credit, and that has been benefiting, from the Fed's targeted lending facilities to lower than investment grade companies itself. The targeted lending that has been created in the US for lower than BBB rated corporates. The decline in interest rates, they reflect a combination of probably lower return on safe assets and a compression of the risk premiums as well. As you can see in the next chart, please, in the next slide, please. The global financial conditions have eased, following the sharp tightening earlier in the year, but the central banks have been pretty swift. And what these actually implies that equity markets are rising with the price earnings ratios itself are kind of in terms of the bullish mood itself of the investors, it is actually being predicated on strong policy support. It's a huge uncertainty on the extent and the speed of the recovery itself. So there's a real disconnect between the financial markets and the real economy, as is apparent. And with that, I hand over to Tom.
Good morning, everyone. Thank you again for joining us. I'm going to do a brief run through of the UK economy, starting with this slide, which is a snapshot of the key indicators that I'm going to discuss in more depth. And as you can probably imagine, it's not the rosiest of pictures. Unemployment is up, as you'd probably expect, at 4.5%, and the employment rate is therefore down. Inflation is quite weak, which is also to be expected given the hit to consumer demand. GDP took a historic hit in April to June of this year, losing roughly 20%. And that is something that I'm going to contextualize in a moment. Public finances have worsened, as you can probably imagine, with tax receipts being lower and also with spending increasing. And international trade has seen our surplus in the UK increase over the course of this year, which I'll discuss in greater depth in a moment. So next slide, please. So the purpose of this slide really is to try to contextualize the economic losses, the GDP losses that we've experienced over the course of this year. And if you can look on the left-hand side of this graph, you can see the 2008-2009 financial crisis and the losses that arose from that. And the worst GDP shrunk by only around 2.1% during that time. It's worth saying that at that point in time, we hit unemployment rates of roughly 9.5% in this country, which I'll contextualize against the unemployment rate now in just a moment. But on the right-hand side of that graph, you can see the huge cut that GDP took over the first 2 quarters of this year, particularly in Q2, and the preliminary figures showing that we've had some promising signs of improvement over the past quarter to August, but that's by no means a certainty just yet. Next slide, please. Okay, so I'm going to set out what these graphs are showing first, and what they show is the evolution of forecasters' predictions for GDP in 2020 and 2021. And for example, in the far left of the left-hand graph, you can see the forecast of just under 2% GDP growth forecast during March 2019. Moving through time, you can see that that remained relatively stable at between 1% and 2%, which, as a side note, isn't exactly the strongest basis from which to tackle another global economic crisis. And then as March and April hit, the forecasts really fell off a cliff, understandably, until we get to the most recent forecast shown on the graph in September at roughly minus 10% GDP loss in 2020. Moving on to 2021, GDP expectations were roughly 1.5% through the first couple of months of this year. And then after that, you can see the sort of evolution of those forecasts as forecasters started to sort of crystallize their view that 2021 would be the recovery year from the basically terribleness of 2020. And you can see there that they are forecasting a 6.5% recovery in 2021. So what can we draw from this? Really, firstly, you can say it's not a V-shaped recovery. If we're losing 10% this year and we're gaining 6.5% next year, then we're not ending up, at the end of 2021, we're not ending up in the same place that we were at the start of 2020. What it really means is that ultimately we're probably looking into 2022 and possibly even on pessimistic views, 2023, before we get back to where we were pre-pandemic. Secondly, it's worth pointing out that these forecasts end in September 2020, and since then there's been a substantial worsening of the pandemic in the UK in terms of more and stronger local lockdowns, the possibility of a national lockdown similar to the one that Ireland introduced just recently, worsening infection rates, and then also the deterioration over the past couple of weeks of the Brexit discussions, which obviously will take effect in January of next year. So what I would characterize that is a situation of probably worsening prospects and at very best, greater uncertainty around what's happening. And so what I would expect is that when the October forecasts come out and potentially the November forecasts, depending on how quickly things crystallize, I would expect a worsening of the forecasts for probably marginally for 2020, but more significantly for 2021. Next slide, please. Okay, so moving on to unemployment. Unsurprisingly, unemployment has suffered a substantial increase. Roughly 700,000 people have been lost, payroll jobs have been lost since March. Redundancies are up both quarter on quarter and year on year. It's worth pointing out that vacancies over the last quarter were improving, but nowhere near enough to recover the jobs lost over the previous period. It's probably worth pointing out that the unemployment rate has a sort of natural level in this country of sort of 2.5% to 3.5% over recent historical periods. And so a 4.5% unemployment rate is actually substantial, as I'll show in just a moment. The other point to make is that these graphs, these figures are all being supported by government schemes, things like the furlough schemes, which are now coming to an end, the replacement of the furlough scheme, the temporary schemes that are being put in place with local lockdowns. And so these aren't really showing the sort of raw picture of what the unemployment trends are. Unfortunately, we're coming into a time where those schemes are ending. There seems to be limited political will at the moment, at least, to extend them at the moment. And so what we may see in a bad case scenario is the cumulative effect of the first wave, the job losses from the first wave, as people are made redundant at the end of, as the furlough scheme has ended, coupled with potentially further effects from a potential second wave that we're living through at the moment, or seems to be taking effect at the moment. And that sort of double whammy could be substantially problematic. It goes on, I'd also go on to say that the longer that this goes on, the more likely these job losses are to become structural or permanent. As businesses, if businesses are going out of business, if entire sectors are being deemed less viable than they were 8-9 months ago, then there's a decent chance that some of these will become structural and therefore a much more long-term issue, particularly going in with Brexit on the horizon as well. And finally, a word on productivity. For a while now, we've had in this country a trend of declining productivity, i.e. output per worker hour or output per worker. And this rather expectedly has taken a further hit as a result of the furlough scheme, as it will have in other developed countries who don't have that long-term decline in productivity. We've 20% down on output per worker, and that's simply a mathematical inevitability when you are paying people for working fewer hours. Next slide, please. Thank you. Okay, so these graphs are similar in terms of they show the evolution of forecasts over a certain period of time. And as you can see, we are forecasting that there is an average forecast is roughly 8.5% unemployment at the end of this year, compared to 4.5% at the end of last quarter. So a lot of catching up in terms of job losses to do. And then 6.5% next year, so regaining a proportion of, but not anywhere near as many jobs next year in 2021. Now, to contextualize that against the global financial crisis back in 2008, 2009, we had unemployment peaking at around 9%. Now, if you think about how much worse the GDP forecasts are, the GDP figures are, sorry, for this crisis compared to that one, there is a substantial difference and there's potentially ground to make up. It's also worth saying that in our view, to remain at this level, to remain at this 6.5%, roughly 6.5% level next year, there is likely going to need to be government intervention of some description. And that's to support two things, the effects of the virus and the ongoing effects of that, and depending on how it evolves, and also potentially, especially in the event of no deal, Brexit into next year. And that fiscal support can take the form of several things. It can take the form of direct job support, such as similarly to the furlough scheme. It can take the form of large infrastructure projects to try and support jobs and create jobs. And it can take the form of further direct it can take the form of state aid type measures in order to subsidize industries. And these may be particularly needed if we end up with a no-deal Brexit, tariffs end up going up, and government has to step in to make the industries which are now paying tariffs viable. Finally, a word on the vaccine. If and when the vaccine comes, there will be a significant boost to consumer and business confidence. Now, that's regardless of whether everyone gets it on day one, or whether we're talking about people getting it in 2022 or 2021 or whatever. The improvements in therapeutics and in vaccine will improve business confidence, and therefore are likely to lead to improving unemployment conditions. Finally, just to talk about productivity, like I said, our productivity compared to our sort of key competitor advanced economies has been declining in recent years. And the way out of that is to try to create higher value jobs. And we've all probably seen the rethink, retrain type adverts from the government, which are designed to try to incentivize or nudge people towards those higher value jobs. And these will, to a certain extent, address any structural unemployment that comes out of the coronavirus and potentially Brexit afterwards. However, those are all medium, long-term plans. Those aren't immediate fixes. And so any structural unemployment that hits in the near term as a result of COVID is unlikely to be directly addressed by those by those schemes. Next slide, please. Okay, so this graph shows UK inflation, CPIH, so it includes housing costs. You can see the vast majority of the bars are in negative territory. They're providing a downward pressure on inflation. We've got relatively low, the result, and this is kind of what we would expect given the hit to consumer demand that we've experienced. You can see in clothing and footwear, for example, and food and beverages, you can see those industries, there being a lot of deals and things like that are forcing prices down in those sectors. However, quite obviously, the factor that is dragging this quite hard into negative territory is restaurants and hotels and hospitality. And that's a consequence of two things, really. The Eat Out to Help Out scheme, which happened in August, and then was kind of voluntarily extended by some businesses into September and October. And then also the VAT cut, which existed, which was brought in and will pervade until January of next year. We're also being kept low by low energy prices as well. Next slide, please. We can see that we're forecasting low, the average forecasts are forecasting low, below target inflation over the next few months and into next year. And generally, I think we can expect that to continue, and we can remain below target for a while, depending on how consumer demand evolves, depending on government schemes to support employment, depending on the prevalence of a vaccine, or the existence of a vaccine, or the introduction of it. A caveat to this relates to Brexit again, however. And in the event that we do end up with a no-deal Brexit, or even a thin deal Brexit, and we end up with significant tariffs on a lot of our products, then it is likely that the costs of imported goods will increase, and the costs of goods generally will increase. And therefore, we can expect a bump to inflation arising from that. Now, that may be somewhat alleviated by government subsidies or something like that, but it's something that's going to be on the horizon. And with the breakdown of the Brexit talks over the course of the past couple of weeks, a lot of those eventualities are going to start being built more heavily into forecasters' forecasts for next year, I would imagine, as we move into October forecasts and November forecasts. Next slide, please. Now, I don't think it would come to a surprise to anyone that our public finances have suffered as a result of the coronavirus. You can see, starting on the right-hand chart, you can see a substantial increase in government, in national debt as a percentage of GDP, so that we are now roughly at the same levels as we were in the 1960s. Now, that's a trend which has been growing since the global financial crisis, flattened off largely due to the austerity policies, and now has increased over the past couple of years. And it's being driven by the obvious factors of increased government spending on things like the furlough scheme. So for instance, £11 billion was spent in August alone on job retention schemes. £20 billion in total in August was spent in excess of the amount spent the previous August. And also lower receipts, corporations tax, income tax, VAT have all taken a hit and are roughly £7.5 billion lower in August than they were in the previous August. Tax receipts between April and August fallen by around 13% year on year. And frankly, the gap between spending and tax has to be bridged by borrowing. So it's hardly surprising that we're that there's an increase. However, it's worth pointing out on the left-hand graph that we have not experienced as much of an increase as was projected or as has been projected, which I suppose is some form of silver lining to that particular cloud. In terms of where we're going, where are we going with public finances? It's tempting to say that we are going to improve and that next year we'll see a retrenchment of public finances. It strikes me as somewhat unlikely, however, especially in the event that the coronavirus epidemic continues to be problematic and further government support is needed to maintain jobs and to prop up the economy in terms of fiscal policy. And secondly, in the event that there's no deal Brexit and we end up in state aid scenarios, then there's a substantial chance of increased government spending as a result of that. So I don't think we're talking about a quick drop again in government spending. It's something that may end up sort of leveling off and then falling over a longer period. Next slide, please. Okay, so this is our international trade, our balance of payments. UK, for context, UK has been running a deficit in goods and a surplus in services for some time. The trade surplus increased in total by 3.8 billion, i.e. we are exporting more than we are importing, to a total of 7.7 billion in the 3 months to August. And this is caused by two things. Firstly, trade in services, our surplus expanded by 3 billion. So we're actually exporting more by way of services than we were previously, compared to what we are importing by way of services. And secondly, trade in goods, our trade in goods deficit narrowed by 0.8 billion, almost 1 billion. And that's probably to be expected because given the retrenchment of consumer demand over the course of this year, there's been a reduced demand for goods. And normally the first thing that goes is imported luxury goods. Now, as an aside, normally an expansion in trade surplus will be linked to a strengthening of currency. So the pound would ordinarily get stronger, but we haven't really seen that. And I think that that is primarily driven by uncertainty over Brexit, keeping the pound where it is. And so ordinarily what you would see is that as you export more, your currency strengthens, and that makes your goods more expensive, which is a kind of countervailing effect to your tendency to export more. But we haven't really seen that happening. I think that is all of my slides on the UK economy. So next slide, please, Lauren. And now I've just got a couple of slides and we're going to talk about financial markets and the risk associated with it. And I've got a couple of slides on that and then I'll pass back to Sagar. This touches on something that Sagar already spoke about to a degree, and you can see on the left-hand side. So we move from left to right on these graphs. You can see on the left-hand slide that there's been a strong rebound, particularly in China and the US, on equities since the peak of the trough of the crisis back in Q1, Q2. This hasn't been supported by fundamentals at all. We've seen earnings per share growth falling, as you can see in the second graph. So earnings per share are going down. Businesses are earning comparatively less, but they're being valued more highly. A lot of the S&P figures are yet to recover, and so what this indicates to us is that there are certain industries, there are certain areas which are being blown up, which are effectively forming something of a bubble as a result of the liquidity that's sort of sloshing around in the market at the moment. So to move on to the far right graph, you can see there that in particular technology shares, you see the blue dot, the value of the companies has increased, but the earnings per share has actually decreased by a similar amount. And equally, telecoms as well, we've seen a slight decrease in the value of telecoms companies, but we've seen a substantial decrease in their actual earnings. And so what this really shows us is that, yes, there is a recovery in equities, but it's not being driven by anything that by the fundamentals of the businesses. There appears to be a disconnect between financial markets or equity markets and the real economy and the real performance of these businesses. Next slide, please. So, and then looking at credit spreads and looking at the risk of businesses, and you can see again working from left to right, you can see corporate spreads initially both for high yield and investment grade bonds increased substantially during the peak of the crisis. But then you can see that they've reverted to almost their long-term median levels. And the middle graph shows that they do look cyclically quite tight. They do look like they are within almost normal ranges in terms of credit spreads. Maybe slightly lower than expected than the sort of like interquartile range, but they are within a historic range. And then you move on to the right-hand one, and it doesn't look so rosy. So whilst a lot of the credit spreads have reverted to median levels, if you look at the ratings, despite a large increase in downgrades back in the first half of this year, we have not seen a decline in the number of companies on negative watch subsequently. So it looks like a lot of companies, having been downgraded or having almost been downgraded, have remained on negative watch as time goes on. And what that indicates is the huge level of uncertainty in both the real economy and in financial markets. And with that, I will pass back to Sagar.
Hello, everyone. Back again. So I'm just going to talk about a little bit about the volatility in the markets, and then yields, and then probably just sum up in the end with a quick look at the overall implications of some of these results that we've actually looked at today. So in terms of the volatility, if you clearly have a look at the slides that we have over there, we have a situation in which the net leverage ratios are actually climbing and hovering around their all-time peaks, but the corporate capital structures are becoming increasingly reliant on debt and low interest rates. But at the same time, if you look at the option markets, they're actually flagging some lingering doubts among the investors. The implied volatilities of, say, several risky assets, including equities and currencies, they're materially above the levels seen in Q1 20. And how do you explain that? I mean, is it perhaps the call option buying spree that could probably explain some of these developments? But what I find remarkable is if you look at the middle panel over there, the long end of the VIX term structure in August was roughly twice the January marks, which, by the way, was about the historical average. And if you contrast that with implied volatilities of interest rates, they dropped below pre-pandemic levels around the same time itself. So if you look at the MOVE index, which is the yellow bar on the left panel of that particular slide, the MOVE index actually captures the implied volatilities of the US Treasury securities, and they actually, they're fluctuating. They fluctuated around the all-time lows of that particular index itself. So volatility compression was even actually stronger at the shorter end. The price of insuring, say, a short-term interest rate risk had halved from the January figures itself, and oscillating probably near its historical minimum. And the price of insuring a long-term interest rate risk was roughly back to the January marks itself. So this compression of interest rate risk levels and the volatility, it's actually helped prop up risk taking by curtailing the funding risk and by contributing to the upswing in the risky asset prices. We expect subdued volatility in the fixed income markets, reflected in part because of the central bank actions itself, as well as the communication coming from central banks around the world itself. Next slide, please. Yields. Again, I mean, Tom touched on this, and I covered this on a global front on the in our slides before. If you look at the 10-year government bonds in US and Germany, they've been trending down, and they've been benefiting from the strong policy support that they've been receiving. In Japan, the bond rate remained anchored because of the yield curve control that they have. But over the year, the decline in the long-term US yields, they seem to have been more pronounced, and it caused substantial compression in the differentials vis-a-vis other global safe assets. But despite the relative convergence at the long end, the US term structure remains steeper, possibly hinting at the varying expectations in the medium-term growth outlook for the different economies, displayed on the chart itself. The interesting thing about yields is that the inflation break-evens, and we've got I was quickly browsing through the questions. We've got a question on this. The inflation break-evens, or the expected, or the inflation expectations in major advanced economies have rebounded from their March lows. In the US, the inflation concentration, climbed back to the pre-pandemic levels across the maturity spectrum itself. But with monetary policy keeping a lid on nominal yields and real yields having dropped sharply as break-evens rebounded, this actually pushed the real yields further into negative territory. I mean, if you look at the numbers, the long-term US real yields sank to all-time troughs in early September, and the short-term real yields actually fell below the German equivalents for the first time, probably since 2014, 2015. All of this fall in real yields is what it's propagating is investors are actually looking for alphas and betas elsewhere. So there's a huge influx of investments in precious metals, particularly gold and silver. And investors are plowing into the, in different forms of metal ETFs away from these negative yield assets. Next slide, please. Finally, I had a quick slide on the banking sector, because a lot of you are from the banking sector today. The banking stocks globally took a bit of a battering at the beginning of the crisis, which was very similar to all other industries and the global stock prices in general. But while some of these other sectors have actually rebounded, the banking stocks are still kind of hovering around levels which are much lower compared to 2020 January. So what is driving this? Well, the sector's seen some losses and loss provisioning, especially for the advanced economies banks. That the loss provisioning has gone up by about 45 billion. About 182% between Q4 and Q1 2020. Obviously, that has been dragging profits down considerably, and banks which were already low, not as profitable, are suffering, continue to suffer from these losses of profitability arising from loss provisioning. But despite these stresses, the banks have been kind of resilient so far, and a lot of that has to be with the CET1 ratio from Basel III. So the banks have been well capitalized. You know, the CET1 ratio, for example, rising from, say, 10%, I think it was 10% in 2020 Q4 to around 15% in 2019 Q4. So the banks were well capitalized to face the downturn. The issue over here is, though, with the monetary policy support that has been extended by the central banks and a generally positive sentiment in the debt markets, banking funding costs have been, you know, they've largely recovered since late March and is kind of back to, you know, the lower levels before the pandemic itself. The only exception in this particular chart, if you have a look at the third panel, is the contingent convertible bonds, or the CoCos, which are primarily used by European banks. They are still nearly double their pre-COVID levels, probably reflecting concerns of coupon cancellations or from payout restrictions. But all of that said, there are vulnerabilities in the banking sector. Credit rating outlooks for the bank are still generally negative. You know, credit default swaps, for example, for BBB rated and high yield banks on that, you know, on the right hand panel of the chart, you know, they have remained elevated on an average about 30 basis points to 127 basis points above their pre-COVID levels itself. So there are risks that has to be kind of be cognizant of within that particular banking sector itself. Next slide, please. Lauren. So just summarizing, the path to recovery is likely to be long and slow, but there are some positive indicators all along the way. I mean, growth is projected in the near term around 4.5% in 2020, maybe recovering to, negative 4.5%. So growth's going to decline by about 4.5% in 2020, and then increase by about 5.2% in 2021. If that follows through, the world economy will still only be about 0.6% above the 2019 levels by 2021. There's been some better than expected optimistic Q2 results, especially in the advanced economies, but the momentum is slowing from what we see in the September and the October figures that we've been able to get so far. There've been there's wide negative outputs in 2021 with elevated levels of unemployment, which poses a significant risk to long-term to growth and scarring in a lot of economies. In the medium term, growth's projected at about 3.5%. The interesting thing about the medium term is some of the risk factors that are associated with the labor market. There's been a significant impact on the informal sector worldwide. So lower income countries, developing economies, almost 90 million are expected to fall under the $1.9 threshold a day in terms of earnings, and that is going to have a huge impact on consumer demand to a great extent, because the fiscal indicator is a lot higher on the lower end of the labor market than it is on the higher end. There's been substantial increase in sovereign debt and debt servicing from a lower tax base as a result of lower GDP is obviously going to be a big risk as well. But all of this, kind of reverses some of the progress that we've made, from the 2008 till 2019 or even before in reducing global poverty. So that is kind of unfortunate in this particular case. Key risks in the global economy, obviously public health factors. How soon can we get a virus out? Global spillovers from soft demands, a weak tourism, lower remittances as a result lower income levels. All of that, is going to weigh in the medium to long run. The financial market sentiment for the time being is fine, but it could change anytime. And depending on how long the virus goes on and how long it takes us to get a resolution to the virus and how well the economy is able to adapt, the financial markets could very easily change. And finally, the damage to supply potential is huge. And that has to be something that we have to be really wary of. On terms of the UK economy, 2020 has been grim, but there's some clear signs of recovery. Obviously, after in August, July and August, the economy picked up. But obviously, with the resurgence of the virus, there is something that we need to kind of look at going forward. It'll be gradual recovery. You can pretty much rule out the V-shaped recovery that was predicted at the beginning of the virus itself. Risks are skewed to the downside, obviously, because of the second wave and with the EU-UK trade deal being in a limbo at the moment. Depending on what emerges out of that, there could be significant risks to jobs and GDP growth rates in the future itself. And finally, government policy in the medium term and the near term is going to be key to recovery. I mean, persistence with employment support schemes, reskilling, retraining programs, all of this fiscal policy is going to be the key to ensure cushioning of the different impacts of this particular virus, and the better policies that can be designed and the longer they can be designed for to mitigate some of these impacts, the better cushioning the economy is going to receive over the medium to the near to medium term itself. Thank you.
Thank you, everybody. I hope you found this interesting. Tom and Sagar have taken us through an update on various aspects of reflecting on the economy and the outlook, and I hope you found that interesting. We now have reached after 10:30 actually, and a credit to Tom and Sagar for getting through such a large amount of material in a relatively short space of time. But we realize we don't have very much time for questions, but we have had a few logged in the chat. So what we will do is come back to you privately on the questions that you've asked. And if anybody has any other questions, please do let us know. We'd be very happy to share our views on those. And as I mentioned earlier, the recording and the slides will be circulated after the presentation. So it leaves me to say thank you for joining us and enjoy the rest of your day. Thank you. Bye.